The world is drowning in debt.
Okay, maybe not the whole world, but enough of it that we should worry.
People are suffering really badly, and yet we have done nothing to prevent this.
In this video, we'll talk about whether we should expect more scenes like this, as crises and conflicts make it ever more expensive to borrow.
Things have changed very dramatically. The Ukraine war accelerated a tightening in global financial conditions.
And we'll also discuss what should be done to defuse the ticking time bomb of global debt.
Creditor economies actually benefit from debt forgiveness.
Wholesale write-off, I think, also sends the wrong message.
That's all coming up on Business Beyond.
Here's the situation. The International Monetary Fund says 60% of low-income countries are at high risk of debt distress or in debt distress already. What does that mean? At its simplest, it means these countries are having trouble settling their commitments and need debt restructuring. That's where the terms of the loans are tweaked in order to enable easier repayment.
Some countries are already in default, like Lebanon, Sri Lanka, Russia, Suriname, and Zambia, seen here in red. But other countries are teetering dangerously close, albeit in varying degrees. That the world economy is facing a set of challenging circumstances isn't helping.
Accelerated inflation. It has become a clear and present danger for many countries. Rising food and fuel prices are straining the budgets of ordinary families to a breaking point. Financial tightening because of the need to counter inflation, hitting countries with high debt the hardest.
First, the pandemic meant that while richer countries could spend more to keep their economies afloat, others found themselves hamstrung by their existing debt obligations that have since become even harder to meet. The inflation-fighting measures by the Federal Reserve have led to a stronger dollar and increased difficulty in paying down dollar-denominated debt.
The current economic climate means words like a perfect storm are thrown around a lot, but debt crises are nothing new. One might ask oneself, why borrow, or for that matter, lend in such a way that spells later difficulty? In other words, how did we get here?
Since the start of the century, pretty much post 9/11, we've had very, very ultra low rates across the board. That's been exacerbated by monetary easing. Low rates aren't great for investors, right? So if you're a US investor or European investor looking to deploy capital, you're not going to be deploying it domestically when you're not really getting a return on that capital. So you're looking for higher yield opportunities, and emerging markets were the perfect destination for that.
Now, that bit is important. Emerging and frontier market debt is associated with higher risk, but also potentially with higher returns for investors. Back to the story.
Countries were told, oh, look, you should access global capital markets, and that way you will get finance that you need that will augment your domestic savings. And so across the world, countries were encouraged to open up their capital accounts, allow much freer borrowing by their domestic companies. Emerging markets and frontier markets became embroiled in this global financial system. And for a while, it was all hunky-dory. It was nice because we're getting all this extra money, your domestic companies. When there was a crisis, when crunch time came, then suddenly all of these creditors say, well, we want full repayment. In other words, they got the benefit of a higher risk premium, but they're not willing to take on any of the risk.
As we've established, that crunch time is now. And if before, low interest rates in the world's top economies pushed money out of them towards emerging markets, there are different factors at play now. JP Morgan says investors have pulled $50 billion from emerging market bond funds in 2022.
Things have changed very dramatically. The Ukraine war accelerated a tightening in global financial conditions, meaning that US rates are rising. And that, of course, starts to reverse some of that dynamic that I talked about, with low rates pushing money out. Higher rates are going to bring money back in.
The ebb and flow of money all around the world may sound abstract, but they have very real consequences for people on the ground. At this stage, we're all familiar with the food and fuel shortages that befell Sri Lanka after it ran out of dollars to pay for imports. In Lebanon, a sliding currency amid a sharp economic downturn led to bank holdups by desperate depositors trying to get their cash out. Devastating floods exacted a heavy human and economic toll in Pakistan, at a time when the economy was already reeling from a balance of payments crisis. The details may differ, but the pain is widespread.
This compromises the rights of the people down at the ground. It's the ability for them to access food and for exchange to buy food when it's necessary. And we're seeing it with some of the wars and humanitarian crises that are emerging in Eastern Europe, for example, right now. And it is definitely exacerbated by the entire structure in the system. There is a need to have a fresh debt architecture.
Let's say Ghana joins the default list. Then the creditors start saying, well, oh my goodness, let's look at Tunisia. Then let's look at the neighboring countries. Then you get much, much more debt stress across the developing world. That would actually destabilize the global financial system. And I do believe that is very likely because of the inaction that we've seen so far.
When countries need bailouts from the IMF is going to want to make sure that that loan isn't being used to service existing debt. Often, that means getting other creditors to agree to debt restructuring. But who are those other creditors? It's complicated. Alongside multilateral lenders like the World Bank and the International Monetary Fund, you also have a group of major creditor countries who coordinate on debt repayment issues as members of the so-called Paris Club. But you also have creditor nations who aren't part of this club, like China. These days, however, private creditors like BlackRock also hold much sway.
The big problem today is really that it's a much more complex scenario now for debt workout. You know, when the HIPIC initiative happened, the highly indebted poor countries initiative, which was a debt relief package way back in the 2000s, that was just public, bilateral and multilateral debt, okay? And that was kind of easy to do. Governments could get together and decide. Now, 60-70% of the debt that most countries have is held by private creditors. And a lot of it is in bond markets. But how do you actually manage a restructuring? How do you get the private sector also to do it?
Experts like Jayati Ghosh, who we just heard there, say that more has to be done to compel private creditors to coordinate more on lending and restructuring. Others point out that private entities get a lot of backing from the government too, especially in times of financial distress.
Very often private sector entities are getting bailed out, but what we're seeing is a rhythm, which is after the bailout or the support or the subsidies, the year later or 2 years later, very often the same entities actually declare windfall profits. And I have a different question to it, is if you were subsidized as a corporation earlier, then why don't you return the subsidy? Why don't we see subsidies also, in a sense, as a debt that company now owes to the state that has kept it alive during a tough scenario?
Speaking of tough scenarios, the pandemic prompted the G20 to introduce the Debt Service Suspension Initiative. That saw nearly $13 billion in payments suspended from May 2020 to December 2021 to dozens of countries. Before that period ended, the G20 and the Paris Club also launched the Common Framework for Debt Treatments to help countries with debt restructuring and liquidity and solvency issues.
It also required private creditors to provide comparable debt relief, although it's far from clear how the Common Framework can make this happen. So far, only 3 countries have applied for debt restructuring under the program. As it happens, a country signaling that it needs some help comes with a sort of stigma, potentially impeding its ability to borrow in the future.
One country which did sign up for the Common Framework is being watched very closely. In 2020, Zambia was the first country to default on its debt in the pandemic era. At the end of 2021, its external debt stood above $17 billion.
the country was lagging behind in terms of the quality of the infrastructure, especially to support economic growth. So that was understood. I think the challenge was how some of this investment was then undertaken. If I was to put it simply or use an illustration, it's like economic indigestion. We took on a lot more than we could actually put to good use in the time in which we took to absorb it.
Zambia, a country largely dependent on imports, saw its citizens battle rising prices as the Zambian kwacha depreciated, while foreign currency reserves went to servicing debt. They received mixed messages from the government as to how that was being handled.
We had a period where the country and the government was acknowledging that the debt was starting to become unsustainable. There were actions that were announced to try and bring debt back into line. However, at the same time, there were actions that were being undertaken, which seems to contradict. On one hand, we say we're going to slow down on debt contraction. A few days later, there would be announcements around new projects that need to take off. All of that obviously then sort of causing a bit of disconnect between the intention and what is actually being done.
Fast forward to today. Under President Hakainde Hichilema, Zambia has now managed to secure a $1.3 billion assistance package from the International Monetary Fund, following months of discussion, and after bilateral creditors, including China, agreed to negotiate a debt restructuring deal with Zambia.
Many are looking at Zambia as a test case for how China treats debtor countries who are struggling to pay, and as an indicator of China's preparedness to work with other creditor countries as it does so.
Beijing's Belt and Road program, where ambitious infrastructure projects in nearly 150 countries were financed with billions in Chinese loans, has helped transform China into the world's biggest lender to developing nations. But it has had to field accusations of trapping borrower governments in loans with the goal of seizing critical assets once they were unable to pay. Others doubt the fairness of the argument.
Well, I've always been very skeptical about the debt trap diplomacy claim. I think it's easier to explain what China did as an example of inexperience and maybe even a certain amount of foolishness rather than any really nefarious plan. And I think it pays to be a little bit cynical here. I think international creditors are using the excuse of China not to grant forgiveness or forbearance, and China is using the excuse of international creditors to make the same complaint. So each side is saying, in principle, we would be willing to be easier going, but we don't want to relax credit simply for you to use that and repay the other.
Let's go back to Zambia. China holds about a third of its external debt. After years of resisting coordination on debt restructuring, Beijing's treatment of Zambia has attracted a lot of attention. Could this be a turning point in getting countries to cooperate?
I think there's still too much political jawboning and criticisms going back and forth, which makes each side very suspicious of the other. But ultimately, what we've always seen, if you study the history of sovereign debt, particularly during periods of great trouble, what we've always seen is that eventually we become reasonable and recognize that the debt can't be repaid, and the only way to revive growth is with significant debt forgiveness. There is never a revival of growth without significant debt forgiveness.
Significant debt forgiveness has come up here before. If the problem is that there is too much debt that cannot be repaid, then the idea that canceling some of that debt is necessary should be fairly obvious. There's widespread consensus that that is in fact what's needed, but views diverge on how much.
Some write-off is definitely required. Wholesale write-off, I think, also sends the wrong message in terms of what it means to borrow and be responsible in terms of being able to repay. Because at the end of the day, it's not as though the debt is forced on any particular country in most circumstances. Some of that debt is bilateral, some of it multilateral, some of it to private creditors. Now, I take a very pragmatic view on this issue. in that in those private creditors, for example, fund managers, they are managing resources that have been entrusted to them by depositors in the case of commercial banks, in the case of pension funds, pensioners and their savings. So when we say that they should be write-off, there is obviously consequences on the other side of the equation.
But there is also the perspective that greater restructuring stands to benefit not just the borrowing nations, but the lending ones.
The world needs probably to get much more serious about restructuring this debt. And I would argue the world should do it not just because it's better for Pakistan and Sri Lanka or Zambia or Venezuela, but it's also better for us. And what I would argue is that the less money is used to repay debt, then by definition, the more money is used to import from the rest of the world, which means importing from the US, Europe, etc. So we actually benefit. The creditor economies actually benefit from debt forgiveness, even if the creditors don't always benefit.
More generally, however, this poly-crisis moment might have led to a shift in thinking when it comes to lending, about what it means to inject external money into a country's finances.
When the West lends to emerging markets, that's a good thing because it allows emerging markets to grow. It raises the standard of living, lifts countries out of poverty, and globalization has definitely been a force for good in that sense. But there are downsides to that. When you have situations like we're in today, where capital is coming out of the country, you can scratch your head and say, well, why on earth did I borrow that much? Why did I allow that much hot money to come into my economy? I should have put some sort of controls in place to prevent foreigners from coming into my local market, or to prevent foreigners from buying up, local assets or depositing in local bank accounts.
And perhaps a shift in perspective of this kind could be key to avoiding the next debt crisis. After all, the more lenders acknowledge they're in a symbiotic relationship, the greater the incentive not to see their debtors fail. And that's all for this edition of Business Beyond. If you enjoyed this video, why not check out some of the others that we have? I personally would recommend our deep dive into the future of Europe. Don't forget to hit like and subscribe. Thank you so much for watching.